The most useful indicator that I have ever found, and with no exaggeration, an indicator that I use every single time I place a trade, is the ATR indicator. ATR stands for average true range, and what this indicator does is gives you the average movement of price out of the last 14 candles. The way it works is it adds up the price movement in total, the total amount of pips each candle moved out of the last 14 candles, and then it divides that number by 14 to give you the total average movement of price in the last 14 candles. Hopefully you can already see why that is so valuable. But if not, let's talk about how we use this indicator. But before we do that, let's talk about how to find it. On TradingView, it's super easy. You go up here to your indicator tab, click indicators, and you type in ATR. It is the first one that is called built-ins. Any trading platform should have an ATR indicator. If it doesn't, you probably shouldn't be trading with it. But the way we use this indicator is to stay in line with the volatility of a market, currency pair, or time frame. For example, there's been so many times that I see a trader or hear from traders and they say, Steven, I don't know what I'm doing wrong. I keep losing trades, and I got a good reward to risk ratio, but I'm losing so much that I'm still losing money in my account. And they'll send me emails of their trades and they're risking 10 pips to make 20 pips, but they're doing that on every currency pair and every time frame. Now, this may work on a 5-minute chart, maybe, right? On a 15-minute chart, possibly. That creates a profit depending on the strategy. But if you're on a daily chart risking 10 pips, when the average, if you look up top here, whenever I go away from my drawing tool, the average movement on a daily chart is 190 pips. You think that 10 pip stop loss is going to get hit? Yeah, 90% of the time. 90% of the time you're going to lose that trade because you're not in line with the volatility of the time frame you're on. The same thing goes for different currency pairs. For example, the euro pound in the currency world is a currency pair that has a very small amount of movement per candle. On the daily chart, we're looking at 50 pips. Again, look up here at the circle, right at 48 pips. That's a full day of trading on average for the euro pound. Whereas the pound New Zealand on the same chart, look at this day, 160 pips. So do you think you need to be using the same exact stop loss when these two markets are moving so differently? One moving in tiny amounts per candle, one moving in huge amounts per candle? No, so that's why we need the ATR indicator to help us stay in line with the volatility of a certain currency pair or a certain time frame to keep from getting wicked out by the market. If you've ever been wicked out of a trade, a lot of that could be because you're not following the volatility of a certain market. So now let me move on and show you how I actually use this in my own personal trading. So based on what you've learned so far in this video, what trend is the Aussie Canada in right now? Well, we've had a high, down to a low, up to a lower high, down to a lower low. With that being the case, are we in a downtrend? Yes, we are. And in terms of structure and support and resistance we look for while in a downtrend, what are we looking for? We are looking for the previous level of support to become resistance in a downtrend. And we haven't gone over this yet, but we actually have a nice inverted hammer here, or a nice shooting star candle, whatever you want to call it. I don't really worry about the names of them. This candle has a long wick to the top side. Again, we're going over candlestick patterns actually in the very next lesson. But right now, what I want to show you is how I would use the ATR to help me predict stops and targets in terms of how I would use that indicator to place those. Let's go ahead and put a position tool on the chart. Right now, the ATR, if you look in the top left corner of the screen, right up here, is 67 for the Aussie Canada. If the ATR is 67, what I want to do is make sure that I am at least one ATR above the swing high of this current pullback to give the trade breathing room. So if up to that high is 30 pips, as you can see right here, this is up to the swing high, then I need to add 67 pips to that. That would be a 97 pip stop loss. Now, I know that I said we shouldn't be looking past levels of support like this in order to take targets, but in this situation, let's just do it anyway. And with that being the case, I may say something like, I expect this in terms of targets, right? This was how I use it for stops. I make sure that I'm at least 1 ATR above the swing high or below the swing low if I'm shorting versus going long. Now, for targets, I may say I'm expecting the market to move 2 times the ATR indicator. So what's 2 times 67? 134. So now I can have a 134 pip target. And again, this would work better if there wasn't a level of structure in the way, but for the purpose of the ATR indicator, just go with it. And that sets me up with a 1.4 to 1 reward to risk ratio. This is how one of the ways that I would use the ATR in order to place stop losses. Another way you can do this is by simply, this is a more simple way, is by saying, okay, I want a stop loss that is 2 times the ATR indicator from my entry. So that would be 134 from entry, right? And in order to get a 2 to 1 reward to risk ratio, I want to have a 4 times ATR indicator for my target. 134 times 4 is 268, and that would be a 2 to 1 reward to risk ratio. And that would be the way your trade setup looks. At this point, you're giving yourself room for your stop loss, and you're accounting for the volatility of the market in terms of finding targets as well. Those are the 2 ways I like to use the ATR indicator. Let's